A lot of people think they can outsmart the market. A lot of different ways, reading those statements, looking at moving averages, trading on inside information. Of course, with the latter, you probably can, but it's illegal and they will catch you because remember, every trade has a lot of information. They can trail you. I love the story about the Serbian woman who got a contact and she goes, "Oh, that's my son in Chicago." But I digress. Now, a lot of people look at charts, and I sure do. And boy, there's a lot of differences in way to how to approach that. Some of them are value investors. They like to buy a security when it's down. There are momentum investors. They like to buy the stock when it rises. And study after study shows these go in and out of favor. And boy, these people are different. But again, I digress. Here are various charts of the Dow Jones, the NASDAQ, different kinds. Here's individual charts of Ford Motor and Microsoft. Boy, they do differ, don't they? What's really going on is that each security is a function of information. It doesn't necessarily even have to be really current or even accurate, but it's what's available. And the price changes according to the information each day. And tomorrow's information is a function of tomorrow's news, which is substantially mean zero, slightly a positive across time. Originally posited by Burton Malkiel's Random Walk Down Wall Street, we can certainly simulate it if it's random, and in doing so we can create some charts and use moving averages. One popular one is to compare a short-term moving average. Here it happens to be green, with a long-term moving average. Here it happens to be red. Of course, the longer the term, the slower it changes. And the idea is that if the short term crosses the long term, downward, let's say, is a buy signal, upward, say, is a sell signal, that it sure looks like there's a pattern there. And boy, do human beings love their patterns. And we've been trained that because notice our cost of being wrong is de minimis. We might get embarrassed, lose a few calories, maybe a finger or a leg, but the chance of discovering whether it's gold, a new farm, or your next X is worth the effort. In the stock market, it's the reverse. And in my own research, looking at autocorrelations going backward and forward 6 days, as well as my dissertation using trend lines for every single stock across a 20-year period, much to my surprise, I found nothing. Thought I'd find a couple of people who maybe are following this, but surprisingly I didn't, which confirms what they call the efficient market hypothesis. So I created a program to compare the buying and selling on that 10-day and 100-day moving averages, and here are the results. Look at that. Real disappointing. Yeah, there's gainers and losers. Here's another run. Again, a lot of winners, a lot of losers. Of course, everybody focuses on the winners. It's just like playing the lottery. Of course, sometimes the lottery winners are just lucky. Here's the computer program I wrote, and the randomizer here is on line 270, and it's kind of just a reinforcement of another lesson with Dr. C Invests.